Introduction to stocks. So stocks are basically also known as shares. And as you go further with your finance and the knowledge, they are also known as equity. So stocks are generally a representation of ownership in a company. What happens is you pay an amount, right, to the company, and that's what we call stocks. So what happens is like so many people have like business ideas and whatsoever, but where's the money to do all those things? The money is always in the people. People have the money, right? So for the people who are entrepreneurs who want the money or funding to be able to do these things, they need the money, right? They need the people who have the money. So you, what we call an investor, you will come and say, all right, I'm giving you this amount of money, let's say $50. So I'm giving you $50, but you have to give me something in return. You can just give someone money and not get something in return. So when you come with your $50 share, right, you get a part ownership of the company. You're now one of the people who own that company, right? Because there's that money of yours, you have the right to make decisions there. Because there's no way that you're just giving someone money and they are not giving you the ability to do this, to provide your decisions somehow, because it's your money. You worked for this money somehow, some way, right? So when you buy a stock, you're just purchasing a small piece of that company, making you a shareholder in general. And then as a shareholder, since you own a portion of the company's assets and earnings, you have the decision making right, because you brought your money. That money is going to be used to buy assets of the company that they will use to bring more money and earnings. Therefore you deserve, you know, to be part of the management, not part of the management, but part of the people who come with the decisions at some point. We'll get down into this in the later stages, where we'll talk about the limitations that you have as a shareholder and what amount of what percentage of decision making do you contribute to the company. So your shareholdership or your ownership just depends on how much you come with. Let's say we have a company here. The company is called Explicit Investments. Let me wrap this as well. Right. So Explicit Investments, right? Explicit Investments is valued maybe, since it's Explicit Investments, maybe 100 million, right? Explicit Investments is valued at 100 million. And then, so the thing is that this company, Explicit, does not have all this 100 million that is needed for the company to run up, right? Explicit will tell you that, okay, so here is that I have my company and it's valued at 100 million. How much do you have? And then you say, oh, I have 20 million. 20 million. Therefore, you have this amount of ownership, 20 over 100 million, which means you have what? 20%, right? Right. Then you own 20% of the company, right? Let's say Explicit is the one who came with the other 80 million. So, because Explicit, okay, then this is the investor. Explicit, they're both investors, but from outside. Explicit has 80%, you have 20%, which means Explicit has more of the rights in terms of voting, because explicit holds 80% of the company. So it's basic. That's how it works. It's as simple as that. And yeah, welcome to stocks. This is lives in stocks, and that's how it goes on. So you get the voting rights, right? So these voting rights, it doesn't mean that you are in the day in, day out of the business, because the day in, day out of the business is done by people who we call management, right? So there are levels to this. If you are a shareholder, it means you are if you are coming with money, it means you are a shareholder, right? Which means you are part of the owners of the business. Then there are people that work for you in explicit investments. I'll continue with explicit investments as my example, right? So we said we have you, the shareholder, right? So who are the owners? So there is you, the shareholders. What you do, you select the board of directors, right? Right. And the board of directors will be monitoring the management. Who are the CEOs, CFOs, managing director, etc., just to mention a few. So that's how the structure will be like. So these managers, the management, are the people who are there, the company, day in, day out. They are the people who knows when to restock. They are people who run everything in the. They are there every day. They basically do everything, right? Then there is the board of directors. The board of directors are people who you choose to monitor the management. Okay, this is basically for publicly traded companies. I'll get into what those are in a few. But the board of directors will manage the management. Then the shareholders, you get information that they from the board of directors most of the times, and the management from both, but you do not have a direct say on what happens. I'll get more into that as I describe everything, because I will start with the fundamentals of everything, such as the descriptions that I'm giving right now, and we'll get more into the technical stuff, which teaches you the evaluation of stocks and things like that. Yeah. So you have put your money in the business, right? Which means that you also deserve. You are not in the business just to manage people, just to know. You deserve to be given a little amount here and there, just for appreciating your time. There is what we call time value of money, and you need to get you need your money has to accumulate, right? So you see that some companies pay what we call dividends. Dividends is just a small percentage of returns that the company makes, right? Let's go what happens, right? You put in your money, right? You put in your 50 million, right? The company is probably going to buy, maybe, let's say we are a company that does trucking, right? We bought more trucks, right? So we bought, this is not how a truck looks like, but okay, I'll just continue from there. We bought more trucks, right? So these trucks are going to transport things. After transporting those things, they are going to make what? More money, right? So let's say they make this year they make 20 million, right? So these trucks have made 20 million, and you're like, okay, 20 million. You deserve something from that 20 million. The company will distribute this 20 million among so many things. Let's say they make 20 million, in profits, for example, just to make it simple. Details will come later, but I need you to understand the basics right now. Right, they've made 20 million in profits. Let's say these are profits, right? Or you can call them returns, right? So after this 20 million, the company will say, okay, on this 20 million, after, let's say, this is, when we say profit, we mean after covering all the cost and everything, right? That has been paid for. So we've done all those things. Now what? Companies, unlike most people, they plan ahead. They will probably take 50% of that and put towards maybe another savings account, or they will say this is for, they will allocate it somewhere for something that will be needed maybe for future projects of the company, usually, which are usually retained earnings. They're called retained earnings. Retained earnings. So the thing is that most of these things are self-explanatory. Retained. This will be the company books, right? So if we retain something, it's like we are retaining it. We are retain is the same thing, just different whatsoever, but it's retained. The company will keep that profit, will keep those profits, and then they will use them for other projects, or they will use them for future sake. So depending on the company policy, they will use it for different things, right? So after they've made all those deductions that they wanted to make, maybe let's say after the retained earnings and everything that the company wanted to make, maybe there's left like maybe 5 million. So this 5 million can now be distributed to what we were calling dividends. So what happens with dividends is like, if you own, it depends with the company, as we said. Some companies, they come in two scenarios. Some companies will say that we're using this 5 million to pay all the dividends, or we are using a percentage of this 5 million to pay dividends. Right. So the company will say, the accountants will calculate how much of returns can we give per share. So they can say that we are giving you 8%. 8%, 6 to 8% is usually the average that you find on the stock market. Some say 5 to 8, but it's around that age. So let's say 5 to 8%. That's what you might get into in the returns. So if you paid 50 million, we said you invested 50 million, right? And you are getting 5% on each share. So you calculate, all right, so I have this amount of shares and this, and I bought them at this price. Those are things that we'll get further into. Now calculating how much you can get per year, or per financial year, or per that period, because some companies might offer you dividends twice a year, but usually most companies will offer you dividends once a year, annually. So we'll get more deeper into that when we get into the stock price for each share price and things like that, just to not make it too complicated as we are just starting. So, right, we mentioned that the companies need to raise capital, basically. Maybe it's an existing company already. they want to extend their operations and they want to develop new products, or maybe they even want to pay debt because debt has some interest which might be hard to be paying at that moment, as of which shareholders are considered last when making those payments, which is something that we'll get into as well. So selling shares just allows companies to raise money without having to repay loans in a future date. That's why companies usually issue shares. So back then, people would be given stock certificates to represent that you had stocks in companies, but today they are now held like electronically because of brokers. So you'd noticed long time ago, most people were not invested in stocks because you had to buy the whole share. Usually, maybe you find like stocks usually start like at $400 a share, and sometimes you do not have $400 to spend on one company. Maybe $400 is all your stocks, which we call a portfolio. So a portfolio is a bunch of stocks that you own. Let's say you have Tesla, you have Apple, you have Microsoft, you have Nvidia, maybe those 4 stocks, right? That's your portfolio with all your stocks. So that is a portfolio. So now, because of brokers, as I was saying, okay, brokers, my handwriting is so ugly, but I'll rewrite that. Because of brokers, or what we call brokerage. Because of brokerage, now people can have an amount of shares, and let's say you now have the ability to say, let's say before brokers, that's what we're saying in the past, you had to, let's say if one share was going for $400, you'd have to start buying at this amount, right? $400 for one share. But today you can buy a piece of a share, which means you can buy 0.05 share, which will be 0.05 of $400, which is approximately not, let me not lie, but which is approximately $20. That's the thing. Life has been made easier. So now you can buy something for $20, then you own 0.05 of a share of a company. Yeah. So brokers is one of the things that you have to look into before getting a share, because they come with a fee. Some may say 0.02% or whatsoever. It just depends with the brokers that you'll be looking into. We'll get more into brokers as we get into more of the fundamentals, but this is something that you just have to know, that you now can buy a smaller amount of shares because of brokerage. That's the thing. So it rises all these things that I've been talking, which is more of the definitions and a glimpse into some of the fun stuff that I was getting into, but a bit is the boring parts. This is basically all the boring parts. But as we go, we'll try to dig in deeper, but these are the important aspects for you to understand the jargon that we'll be using, such as shares, stocks, which we can use interchangeably, dividends, whatever, everything that we're talking about right now is just for you to understand the financial world, because at some point, not at some point, you definitely have to get into the news. That's where you get some of your information that you can use to trade. It's not always that you're using the numbers. The fundamental aspect is the most important, because that's how you can make money. That's how you can make it in the stock market. So, the stock price is determined on the stock market. Right. We talked about what a stock is already, and we now know what a stock is. You know what a market is. This is the place where people go and buy and sell things, right? So a stock market is where we go, buy, sell, or whatsoever in shares. Basically, that's what a stock market is. And there are things that causes prices of stocks to fluctuate or move, which are a matter of supply and demand, which we'll get further into, company performance, these are usually the major factors. Then we have like macro economic factors. Nice thing being taught by someone with a background in economics and finance. This all we'll talk about it, and we'll go into the other factors that will be affecting the prices of the stocks. So these things are important because you need to know how your stock is going to fluctuate, which direction it's going to fluctuate. Okay, in stock markets, things fluctuate in two ways, that it goes up or it goes down. The price can go up or it can go down, or it can remain at the same point, right? But you're never going to buy or sell for the stock market to be at the same place. You're probably going to buy when you're expecting that the stock will increase in value. Maybe it's because of the performance, maybe it's because you know that people want this stock, maybe there are different factors, right? Just like if OpenAI today was to introduce was to publicize them as a public company, and when they were going, I'll get more into detail about that later as well. So let's say ChatGPT, OpenAI, the parent company of ChatGPT, if they were going to say that we are now becoming a public traded company, we would know that the demand of this product would be so high, such that if you are able to just get in at the first time, there is a probability that the price will go up, right? But you have to be smart as well. There is the thing that you know that the demand is going to be so up, such that the product is going to be overpriced. Then you know that even if the demand is so high right now, because of company performance and company real value, the price has a possibility of going down, which we'll get into. So you basically just have to know these things so that you know if when you find the stock that you want to buy or that you want to short, we will get into those terms as well, so that you know what you have to do when you're on the stock market. But so long as you understand what the stock market is, these factors that I've told you that affect the stocks, you will be fine. And these things, we will all get into deeper knowledge of them. Just that you have to know the definitions right now, and basically these are like our principles, not really principles, but just the introduction to this so that you get all of this in due time. Right? So, we've just been saying stocks, and we describe what they are, but there are different types of stocks. So basically, there is the common stock, and sometimes there are preferred stocks. These are the only ones that we'll talk about. The common stock is the basic stock that we usually think of every time that we hear the word stock and things like that, right? It's just the basic ownership with voting rights or in a company. You get the rights to vote. You are the last people to be paid. Then there is preferred stock. So preferred stock are just people who come in usually for a certain amount of time, certain period of time, let's say 10 years, 5 years, and then these ones do not get the voting rights on the preferred stocks, and they get their dividends before the common stock. So the thing is that the common stocks, we can say they are the actual owners of the company, then the preferred temporary owners. Just to make it simple and to clarify how this works. These ones never have the opportunity to make votes, so they do not have a claim, because we are saying that they might be there for a short time, and we can give someone who's here for a short time that amount of voting rights. So because of all that, they get their dividends first. Even if the company fails, they are likely to get their dividends and they'll get their money back, definitely. But common stockholders, sometimes when the company fails, you sink down with the company. Yeah. There are different types of preferred stocks, but we'll not be getting down into them as it's not that more important. Yeah. So, dividends, we went through that, and before we conclude for this session, I'll just give an example and just tell you how people make money through the stocks, because I just mentioned dividends, which is not the only thing that makes you have money in the stock market. Let me talk about one of the other things. Right. Let's say you buy shares in Apple, right? Let's say 100 of them, right? Now you're a part owner of the company. And then when you bought this stock, it was for $100, right? It was $100 per share, let's say. Which means you paid 100 by 100, 10,000. That's what you paid, right? So you have invested 10,000, which you used to buy 100 shares in Apple, right? Apple comes with iPhone 16. So iPhone 16 and the iOS, let's say with the iOS 18, the iPhone 16 and the iOS 18, they are performing so well. It's immaculate. It's wonderful, right? Everyone on the stock market says, yes, this is the product, right? Let's say people start saying, right, this is the best product Apple has produced. Hence, the value of Apple will go up because, let's say they come with new ways to let's say they integrate AI with the product, and the integration is not within other companies, and it's just immaculate, it's just wonderful. That's what we call increase in value, right? That increase in value will also cause an increase in value of the stock, right? It means now people will buy more iPhones. People are saying we are declaring more iPhone 16s and things like that. Probably the share of Apple will increase in value. Let's say it goes to 150. Right, let me write it here. And it goes up to 150. 150 per share. Right. Because it's now 150, it doesn't mean you don't have your 100 shares. You continue having your 100 shares. Right? You bought them for 100. And now they're 150. Which means that how much money do you have in Apple? You have 100 times 150. Now you have 15,000. And all this time Apple was making this iPhone 16, iOS 18, and integration of AI, you were busy sleeping at your house. Yeah, you were just busy sleeping at your house, snoring, and now you wake up, you now have 150,000. So this is the other way that you make money in stocks. And the following year, Apple, on top of this 15,000, Apple in the next year, they come and say that you are receiving a 5% dividend per share. So you're now saying 5%. Okay, let me use percentages, not to be too complex. Let's say 5%. They said they are giving, let's say 5% per share. Okay, dividend. For future reference, I'll be using div for dividend. So 5% per share, right? Times 150. Then, and you have how many shares? You have 100 of them. Then you make the calculation. I don't have a calculator by me, but still, we can calculate that. 0.05 times 150 times 100, 750. Right. So you now have 750 and 15,000. Basically, I'll continue talking about increasing your shares in the later future, so that you understand how this all grows to a larger account, how your money grows to the largest of amounts. So now you have 750 and 15,000. Now you have 15,750. Yeah. We'll get more into all of these things. For now, you can digest those, and see you on the next episode.